Hey folks, this is section 1-1, corporate investment and financing decisions. So every business has to acquire assets, real assets. And those real assets, they have to pay for them somehow. The investment decision is what real assets a business will acquire. The finance decision is how will they pay for it. So your book lists a lot of examples of investment decisions and financing decisions. All right. So one example they say is Walmart, a U.S. company, invests $12.7 billion primarily to open 458 new stores around the world. New stores are assets for the company. They will generate future income for the business. That's what makes them a real asset. Walmart had to find a way to pay for this massive investment of $12.7 billion. How did it do it? Well, part of the way it raised the money was it issued $5 billion in long-term bonds. The rest of it paid for through some other method. It might have been bank loans. It might have been the issuance of stock. Investment decisions. A corporation wants to acquire certain assets which will generate future income. Finance decision. How is the company going to pay for that? Let's take another example from your textbook. It says Boeing, a U.S. company, delivers its first Dreamliner after investing a reported $30 billion in development costs. And that's the investment decision. And then it reinvests $1.7 billion in profits. That's the financing decision. All right, so let's think about this. Real assets that a firm needs to acquire can either be tangible or intangible. A tangible asset might be those buildings that Walmart acquired. A tangible asset might be a certain number of aircraft that Boeing produces. But before Boeing ever produced an aircraft called a Dreamliner, right, which is an interesting story itself, you can read up on it. But when it produced the Dreamliner, it took $30 billion in research and development to come up with a viable prototype. That $30 billion does not mean that they have a bunch of Boeing Dreamliners sitting around or a bunch of machines ready to build it. It means that they have spent $30 billion between engineers, marketers, a whole range of people building, testing, and getting approved this Dreamliner, the largest airship of its design. That is an asset, because that asset will then produce income in the future. I mean, they'll have to have more investment. They'll have to actually build all of these airships, which is going to be another huge investment, but then they'll sell them. It was an intangible asset that they created, which was this working, viable blueprint for a Dreamliner, which took $30 billion to get to that stage. All right, they had to finance it somehow. The $30 billion they paid didn't come out of thin air. So maybe they issued some stock to finance a portion of it. Perhaps they issued some bonds or took out bank loans to finance a portion of it. The other way that a company can finance major investments like this is to reinvest its own profits. If a company is cash flow positive at the end of the year, because it's throwing off a lot of cash flow, which Walmart does, they can use that money to finance the building of new technologies And that's exactly partly what they did. It said they used 1.7 billion in profits to help pay for the 30 billion in development costs. So it was a small portion, but maybe they helped develop it over many years, and each year they used some of the reinvested profits. Okay. Sometimes investing decisions go well. For example, GlaxoSmithKline, a UK company, your book tells us, spent $4 billion on research and development for new drugs. Well, those new drugs will, if they're high volume drugs, meaning many people will need them around the world, and if they provide a real benefit, that's going to be a windfall for the company. But they had to spend $4 billion in R&D before they even had that opportunity. Okay? Sometimes investments go well. Other times investments go very poorly. Your book notes two really egregious examples of poor investment. One was when Bank of America purchased the home mortgage lender Countrywide Financial Corp in 2008 for $2.5 billion. Well, if you know your financial history, 2008 was a terrible year of recession set off by the subprime housing crisis. We can get into that another time, but suffice it to say, there were many homeowners who could not pay their loans, and when homeowners stopped paying their loans, it had a ripple effect through the banking sector, the mortgage sector, the security sector, which nearly toppled Wall Street, and the government had to provide a bailout to get some of the companies through it, let other companies go bankrupt. Well, this Countrywide mortgage, it had billions of loans, hundreds of billions of loans on its books, and 20 billion in mortgage-backed bonds went default, and Bank of America had to eat that cost. It was a terrible investment decision. I mean, it seemed right at the time. It was the era of financial conglomeration, mergers and acquisition in the banking and finance sector. Glass-Steagall had fallen, some over 10 years previous to this, and just bad timing. Another example was Iridium. So Iridium was a client of mine when I worked on Wall Street. We provided financing to them. And your book notes that Iridium was a major flop. Iridium soaked up about $5 billion in investments before it started operations in 1998. Iridium was this idea that we would have a truly global cell phone. A cell phone you could take anywhere. You want to take it to the desert, take it to the desert. You want to take it to the wilderness, take it to the wilderness. You want to take it on the ocean, take it to the ocean. You'll still have a cell signal. I mean, it sounded like the next generation thing. But turned out it was a huge, bulky item. It had in very high costs, and there just wasn't a significant demand. Well, the company had already invested $5 billion of mainly other people's money to develop the product, and now there wasn't the demand there for the product. So very quickly they couldn't service their debt obligations, and they went bankrupt. And not only did Iridium go bankrupt, but a lot of investors lost a ton of money in the deal. Now, you'll be happy to know that Iridium subsequently was restructured and is now providing that global satellite network to commercial clients. But it's never what it was originally intended. A lot of people lost big investments on that. So investment decisions are important. Now, you will hear this. The investment decision is more important than the finance decision. And you would be right. The investment decision is more important than the financing decision, but make no mistake about it, the financing decision is incredibly important. All right? So the investment decision is who you marry. The finance decision are your kids. I don't know. They're both important. Maybe that wasn't the best analogy, but they're both very important. All right. When we make long-term investment decisions, they're often called capital budgeting decisions. And major investments in property, plant, and equipment actually go on your financial statements as an asset called CapEx, or capital expenditures. The way that you finance your investments is called capital structure. So what percentage of my investments am I financing via debt, and what percentage am I financing via equity? Let me explain to you what I mean by that. Virtually every investment is financed either by some form of debt or some form of equity. Debt might be a bank loan, or it might be bonds. Equity financing might be common stock or preferred stock. And there are many other hybrid instruments and instruments in between. It's like when I go out and buy a house. I want to include in my portfolio of assets, biggest asset most people own in their lives is a home. So you go out and you buy yourself a $500,000 home here in Tucson, Arizona. Well, most people do not have a $500,000 in their own money that is equity with which to finance the purchase. So what they do is they take it's $100,000 that they've saved up of their own money that's equity, and they invest it to buy the house. Then they go to a bank and they get a mortgage loan from a bank or a financial institution for $400,000, which they'll eventually have to repay over 15 years or 20 years or 30 years, however they finance it, to that financial institution. We would say that the capital structure is 20%, that's $100,000 in equity, and 80%, that's $400,000 in debt, is financing the investment, the purchase of this asset, which is your home. All right, last point. Why do businesses make investments? They make investments so that they can produce future cash flows. When we think of a business, you may think of it in terms of assets, what we own or what we spent to create a trademarked or patented idea. But when you think of assets, what you really should think about is the fact that these are things I have invested in that will produce future cash flows. And that's what a business needs. It needs constant cash flow. When you own your home, right? You own your home, and we said earlier, maybe bought a $500,000 home, financed it, 80% from debt and 20% from equity. Well, how are we going to eventually make that 100% equity? By paying off the loan over, let's say, 30 years. How are we going to pay off the loan? We need cash flow. How are we going to get that cash flow? For most of it, it's our job. Our job provides the cash flow to pay off the debt. So you should think of assets primarily as future cash flow generators. That's why businesses need to continually invest, and that's why they need to continually finance their investments. I want to talk to you a bit more about financing decisions. Your book in table 1.1 talks about some financing decisions. Reinvesting profits. There are two principal ways that a corporation or a business can finance any sort of investment. One, it can generate income at the end of the year, cash flow at the end of the year. Income is revenue minus expenses. So it could generate this income or this cash flow that it could then use to finance the purchase of new investments. It's using its own cash generation to finance the purchase of new investments. That's called reinvesting profits. The other major way that a company or corporation can finance an investment is by raising the capital from outside sources. And that comes in two general baskets. One is debt and one is equity. So when a publicly traded company issues new shares of stock, it does an offering, a stock offering. It will raise money in exchange for the issuance of new stock. And that's one way that a company can finance a project, by issuing new ownership of the company. You might have seen it on Shark Tank, right? Someone comes into the business, they own 100% of the business, or they own, between them and their other investors, they own 100% of the business. And a shark will say, I want 15% of your business. All right, so what the owner can do is they can just sell them 15% of the business and give them 15% of the existing shares, or they could theoretically create new shares equal to 15% of the overall business in terms of the number of shares, and in that way raise money. In other words, the existing shares kind of get diluted. If the existing shares were 100% of the shares and then new shares are created in order to sell new shares and raise more money for the company, then the existing shares get diluted. The pot's no longer a size 100%, it's size 115%. So those 15 new shares, it was 115 shares now, are the 15%. Okay. So debt or equity are the two ways that a company can finance an investment if they're raising outside capital. So let's say they wanted to use debt to raise outside capital. How could they do that? They go to banks or a consortium of banks and get loans. The banks make loans directly to the corporation, and the corporation has to pay it back with interest over time. That's money. It's other people's money. They could also go to the bond market. This is where a company gives small loans, gets small loans from individuals like you and I. Each of us, just like we could buy stocks in Apple, we could buy Apple bonds. All right, or we could buy Tesla stock, we buy Tesla bonds. Bonds are these small loans that individuals make to a corporation. The corporation issues the bonds, which is a promise to pay back a certain amount of money and a certain amount of interest to whoever buys the bonds, and the person buys the bonds by giving money to the company. So it's basically a loan from a bunch of individuals as opposed to a loan from a bank. And so these massive bond issuances create these bonds, and these bonds, just like stocks, will trade on a secondary exchange. Well, not quite like on the stock market, but some do. But there are ways that bonds are change hands between individuals. All right. So let's keep going here. Whenever you think of a financing decision, you think of, okay, what am I doing to pay for an investment? But when you're thinking of a financing decision, you have to broaden your thought a little bit beyond that to think, just like, what's my capital structure going to look like? What are the changes that are happening to my capital structure? For example, if I was borrowing money using short-term commercial paper, this is a very short-term line of credit with a bank. If a company is borrowing using short-term commercial paper and it doesn't want to have to do this kind of like short-term financing anymore, it wants a much more long-term debt, what it can do is issue bonds, which are long-term fixed rate instruments, and it can use that to pay off the short-term commercial paper borrowing. So maybe no new capital is raised. Maybe there's 100 million in commercial paper being replaced by 100 million in bonds. So there's really no additional money for the company for purposes of making investments, but it's still a financing decision because you're changing your capital structure from dependency on a short-term debt to a dependency on a long-term debt. Likewise, just like a company can issue new shares of stock in order to raise money, it's basically giving away a portion of the ownership of the company to raise money for the corporation. Just like that can happen, stock can be bought back. The corporation could go out in the secondary markets onto the stock exchange and buy its own stock back, right? People like you and me are owning Apple Corp, but Apple Corp can come along and say, hey, we are willing to buy back stock from any of the people out there who want to sell it to us. We'll pay you a little bit more than it's trading on the open market, on the stock exchange. So people are like, sure, I'll sell it back to you for a little bit of a tidy profit. Why would a corporation choose to do that? Because it wants less shares out there. It wants less owners out there. Now, we can talk about in a lot more detail why that is, but it basically improves the rate of return afforded to the stockholders. And you always want to keep your stockholders happy. You want to cause wealth generation for them. That's one way to do it. The people that get paid, that sell the stock, they sell it for a higher price than it's trading in the market. And the people that don't sell the stock, there are less shares out there, so their stock could theoretically be worth more because of just simply less shares out there. All right, so when a company chooses to buy back stock, they're going to lose money. They're going to have to give out money they're going to have to buy that stock back. It's going to cost them money. Just like floating equity, new equity stock brings in money, buying it back costs the company money. It just paid off a bunch of existing owners now who are not owners anymore. Okay? That is a financing decision. It clearly will not finance new investment. In fact, the company better have a lot of cash on hand to be able to do that and have no other investments on the horizon that it needs to finance if it's buying back stock. But it's still considered a financing decision because you're changing your capital structure. There's now less equity relative to debt in the debt-equity mixture. So things like buying back shares or paying dividends. A corporation, at the end of the day, it has income at the end of the year, right? It can reinvest those profits back into the business. And it'll typically do that when it has new investments that it wants to make, right? It uses that capital, reinvested capital, to finance a new investment. But if a company has tons of cash that it's throwing off, and it doesn't have really good investment potentials out there that it sees that it wants to make now, what it'll probably do is pay out dividends. This is where just cash payments from the profits to the existing shareholders. The company pays out profits to shareholders. Those are called dividends. So every shareholder gets some money to put in their pocket. That's a financing decision because that money could have been used to create bigger investments or raise cash on the balance sheet, but instead it was used to pay just some cash flow to shareholders. So it's a financing decision. Anything that changes the capital structure is a financing decision. Anything that affects the shareholders or the debt holders is a financing decision. When a shareholder gets paid out a dividend, they just got extra cash into their pocket. They're happy about that. Makes them want to own that stock. In fact, there are people who buy only stocks that pay strong dividends every year. So it's a financing decision. So the next major topic in section 1.1 is how are we going to structure our business? How are we going to organize our business? Legally, how are we going to structure our business? Are we going to structure it as a sole proprietorship, a partnership, a corporation? There are something like 27 million businesses or firms in the United States of America. Most of them, 73% of them, are sole proprietorships, which means like a mom and pop local little shop. But a sole proprietorship is more than just the size of the business. It is actually a business structure, a business organization. And it's a legal designation that impacts is how the company is taxed, how the owners are liable. Right, so only a small percentage of businesses are corporations. Many of them are partnerships, and most of them are sole proprietorships. So let's talk about these different forms. Most people, when they start a business, it'll be just the husband and the wife or just a single person, and that's a sole proprietorship. Or maybe it'll be some single friends that get together that are maybe went to college together, went to high school together, they're friends. They believe in each other and they have a mission that they want to do together. So they form a partnership. These legal entities called sole proprietorship, single person, or a married couple, or a partnership, which could be a bunch of people that have come together. They form a business legally called a sole proprietorship or a partnership. Most businesses, over 80% of them, fall into one of those two categories in the United States. Now, here's the benefit of forming or organizing a corporation, organizing a business as a partnership or sole proprietorship. The benefit is you're tax advantaged, meaning you only have to pay taxes once, one time. You and the business are indistinguishable legally. You and the business are indistinguishable legally. Therefore, you have to pay taxes once, as if you're paying your personal taxes, paying your business taxes, all the same thing. Okay. Means you only have to pay taxes once, which is good. That's a benefit. More money to keep in your pocket. The negative is you have unlimited liability. If your corporation gets racks of debts that exceed assets and you can't service that debt and you go bankrupt, you are personally, not just the business, but you personally and all the partners personally, or the owners of the sole proprietorship personally, are responsible for those debts. It can drive you into personal bankruptcy if your business fails, because you and the business are indistinguishable, really, for legal purposes. So the chief benefit, you're going to save taxes by only having single taxation, only taxed once. The negative is you have unlimited liability. If that partnership or that sole proprietorship is sued and a judgment is leveled against your partnership or your sole proprietorship, your firm, it's leveled against you because you are indistinguishable from the firm. You are the firm. You are the owner. You're the operator. Okay. Therefore, many businesses will form corporations. And whenever you think of big corporations, those are all, most of them, the vast majority will be corporations. Why would you incorporate? By the way, when you see a business that says Inc. at the end or Corp at the end, it means it's a corporation. It's been incorporated. Again, corporation is a legal designation. You file to be incorporated in a particular state, say the state of Delaware or the state of Texas or the state of Arizona, and you become incorporated in that state. When a business or a firm becomes incorporated, becomes a corporation, is now a separate legal entity from the owners. Okay, now, it may be a closely held corporation. It may be the same two partners you had before when it was a partnership, now it's a corporation, or the two owners owning 50% each. But those people are now legally distinguished from the corporation. The corporation becomes its own legal person. That's right. In the United States, corporations, only corporations, not partnerships, not sole proprietorships. Most of the businesses are not this way, but corporations are separate legal entities from their owners. And that affords some real benefits. The most important benefit is that the owners have what's called limited liability. If a corporation had two owners and each of them invested $100,000 in the business and the business went bankrupt due to a lawsuit or went bankrupt because they couldn't pay all of their bills and so they just had to shut operations down, the two owners who invested $100,000 each will lose the $100,000 each maximum. They can only lose their investment. But after that, none of the debtors can come after, none of the creditors, can come after the owners and say, now pay us whatever else is due or whatever else we were able to sue you for. No. The corporation is the separate legal entity. It has owners, but the owners are not liable beyond their investment in the corporation. So the greatest benefit for incorporating for the owners is limited liability, limited to the amount of investment you actually make in the corporation. Okay, now there's going to be a trade-off. The trade-off is much higher costs in most cases. Corporations are subject to what's called double taxation. Because the corporation is a person, it will pay corporate income taxes on all its profits. And then when those profits are distributed to the owners of the corporation, they will pay taxes on the distribution of the profits. They will pay what's called the taxes on their dividends. Or they will buy and sell securities if they're actively traded in something beyond a closely held, publicly traded corporation. If they buy and sell securities, buy and sell stocks in the company, stocks are ownership in a corporation, You'll have to pay capital gains tax on any profits you make from a sale of stocks that have risen in value. So there's double taxation. Why do most people structure their businesses as partnerships? Because most businesses are small businesses that want to retain as much money as possible. However, that comes with a risk, and the risk is unlimited liability. Why do businesses incorporate? Because they want to have limited liability for the owners. Right? They want to have limited liability for the ownership. However, it comes with the cost of double taxation. The corporation pays taxes, and the owners pay taxes, and those is double taxation. Yeah. You know, so much of this decision when you're starting a small business of whether to create a partnership or to create a corporation. It doesn't matter what size you have, you can incorporate even when you're small, just like you're a partnership. Usually comes down to how risk averse the people are, or how knowledgeable they are of business to know whether they should be risk averse. Right? If I were to incorporate a small business that I was going to start, if I was going to create a small business, I would definitely incorporate because I'm risk averse. I don't want it hanging over my head that I could have a lawsuit that could wipe out me and my family. I'd like the business to be a standalone entity that I'm investing in, even if I'm managing it, even if I'm running it, even if it's my baby, right? I know other people that, hey, they're not scared. They're ready to take on the fight. They know they're going to succeed, so they want to keep every penny that they can. So they're going to do a partnership, or they're going to do a sole proprietorship if it's their business. Let's talk a little bit more about corporations. So, only, like I said, a small percentage of businesses are corporations, like 6% of businesses are corporations. But many of the very large firms you've heard about, Apple, Tesla, Walmart, right? These are all very large, publicly traded corporations. That's why you've heard of corporations. Now, corporations, you have to think of three groups of people when you think of corporations. You have to think of the owners who own the stock in the company. They own the company because the company itself, this separate legal entity, this corporation, issues stocks in exchange for ownership. So the owners effectively give money to the corporation and they take ownership of the corporation. Okay, they own its stock. Then there's the managers of the corporation, which are the people who run the day-to-day business of the corporation. Now, if it's a small little corporation, the owners are also going to be the manager of the corporation. For a large corporation, a publicly traded corporation, or a large corporation, there's going to be millions of stockholders, just like you and me. Every time we go out and buy stock in Apple, we buy a partial ownership in Apple. But we're never going to get sued for anything, right? Or worst can happen is Apple stock crashes and we lose our investment. That's it. We have nothing to do with the day-to-day operations of Apple. When Apple wants to make decisions, it doesn't consult us, even though we might own stock in them. We might be partial owners in Apple, right? The business is run by the managers. The managers are the chief executive officer, or CEO, the chief financial officer, CFO, the chief operating officer, COO, all the employees, which could be thousands upon thousands of employees, all work for this corporation. But the managers are the people who are making the decision. They're called upper management, right? And they usually make the management decisions from corporate headquarters. They are hired by the owners, by the stockholders, to manage the corporation well, so that the corporation continues to produce good returns, make wealth generation for the owners. If managers do a good job, they're retained. They do a poor job, they're fired, and new managers come in. There's a third group of people you need to be aware of. These are the representatives of the owners, of the stockholders, to the managers. This is called the board of directors. So each, depends how the bylaws are structured, but let's say every year, the owners of the corporation, the shareholders, will vote on a board of directors. And that board of directors is in charge of hiring and firing the managers and is involved in some of the very meta high-level decision-making in the business. They don't run the business day to day, that's the managers, but they give some guidance and direction to the managers and they hire and fire them on behalf of the stockholders. So there's the owners who are the stockholders, they're their representatives who are the board of directors, and there are the hired managers who are the managers, right? The CEO, the CFO, and then all the employees of the corporation. One last thing we need to say about corporations. Corporations, especially large corporations, especially publicly traded corporations, have an indefinite shelf life. They could exist as a corporate person for theoretically forever. There is a reason for this. A publicly traded corporation has thousands, millions of owners, shareholders who buy and sell the stock as they choose. All right, so if some of those stockholders die, no big deal. Someone inherits the stock, either buys it or sells it. If someone no longer wants to own the corporation, they just sell to somebody else who buys it. So there's always a supply of owners. Likewise, management. Management runs the business. If management doesn't do a good job, the board of directors representing the shareholders will fire them. If the CEO and the CFO die in a plane crash, the business isn't over because the leadership is gone. New leadership will be hired, right? So because you can continually have new management hired and bad managers fired, the business can continue to exist generation after generation. Likewise, the board of directors are regularly voted on, and good board of directors will remain on the board for perhaps 10, 20 years, and then bad board members, they will be relieved of their duty by the shareholders when the shareholders vote. So the benefit of these larger corporations, these publicly traded corporations, they can keep going on for theoretically forever. Now, in reality, somewhere along the line, things are going to break down, and they won't. But there are examples of corporations that have lasted a long time. Your book makes note of one, makes note of the Hudson Bay Company. It was formed in 1670 to profit from the fur trade between northern Canada and England. And according to your textbook, it still operates as one of Canada's leading retail chains. Right, so 1670, it's well over 300 years that this corporation has been going. All right. Maybe I should make a note of a few more business organizations. So we generally spoke of a corporation and a sole proprietorship and a partnership. Let's review, and I'll add a few more terms. Sole proprietorship, you and the business are indistinguishable. It's just you or you and your spouse as the owners and managers of the corporation. Again, that's a single taxation, unlimited liability situation. Now, let's say you have 3 or 4 friends, you all want to form a company together. You can form a partnership, which again, it'll just, the business is indistinguishable from the people. Each of them get their share of the partnership. Unlimited liability, single taxation. Now, you can also have a partnership called instead of a general partnership, which is what I've been describing to you, you can have something called a limited partnership. A limited partnership is a partnership where you have certain general partners, right, where they're indistinguishable. And then you have limited partners who cannot be sued beyond their investment. So it's not quite a corporation, it's still a partnership, but there are limited partners. The limited partners, however, cannot give management to the corporation, right? They act purely as investors in the corporation. So the general partners, they're going to be owners. Again, we're talking about smaller businesses here, not larger businesses, but In a limited partnership, the general partners will own and manage the corporation. They have unlimited liability, single taxation. And then there's the limited partners who will not have any role in management. They're just there to provide capital to the business. But those limited partners can only lose their investment and no more. That's another legal option. So now we've talked about sole proprietorship, general partnership, which is what I mean when I've been saying partnership, and then this limited partnership, which allows for special limited partners. There are other designations like corporation. There are maybe four designations of corporations you should be aware of. There is the C corporation, which is what I've been talking about, the C corporation, and that comes in two forms: closely held corporation. This is where you have only a few owners. Okay, it's usually a smaller corporation. It's closely held by a few owners. Or a publicly traded corporation. This is where it's owned by many people, so many people in fact, that the ownership interests, which are called stocks in the company, right, are trade on stock exchanges. Those are publicly held corporations. So we have these C corporations that are closely held and the C corporations that are publicly traded. There's also something a little bit less than that called an S corporation. An S corporation is something more like a partnership. It doesn't have the same protections that a full C corporation has. Remember, a full C corporation has double taxation, that's the negative, but the positive is limited liability for all the owners, right? And it could continue to exist effectively in perpetuity because of the division between ownership and management. Okay, the S corporation doesn't quite rise to that status. It's somewhere between what you'd think of as a C corporation and a partnership. Let me bring up also to you a professional corporation. A professional corporation is a corporation which has the protection of limited liability. It also has double taxation, but it does allow for lawsuits for malpractice. So professional corporations apply only to people in professions that are considered professional and they have a governing body, an accreditation body. Think doctors, think lawyers, think engineers, architects, folks that they have to be licensed to be that professional. Usually requires an advanced degree, passing boards, and keeping up your continuing education. They're held to a higher standard. So whereas it's a corporation, as you would understand a corporation, double taxation, limited liability. If one of the owners, who is also a manager, has malpractice, that one person can be sued beyond their investment in the business. They can be sued personally, but just that professional, not the other doctors on staff at the business.